Introduction to CFDs. In this video, you will learn: what are CFDs, types of CFDs, advantages of CFDs, disadvantages of CFDs, and see some examples of CFDs. What are contracts for differences? Contracts for differences, also known as CFDs, are financial derivatives that allow investors to participate in the movement of asset prices without full ownership of the asset. CFDs are over-the-counter financial derivatives that are traded through a dealer network and not through a formal exchange. CFDs simulate the value of the underlying asset, which can be a currency, a share, a stock market index, or a commodity. For example, when you buy one CFD of Microsoft, it is like buying one share of Microsoft, with the only difference that you don't own the share. All profit and loss is paid in cash and is determined by the difference between the purchase price and the selling price of the CFD. Let's compare XYZ share to XYZ's share CFD. Starting with the XYZ share, we bought on the 17th of November 1,000 shares of XYZ at $10. The value of our position is 10 times 1,000, which equals $10,000. On the same day, we closed the trade at $11. The value of the position became 11 times 1,000, which equals $11,000. Total profit for the trade, $1,000. Now let's look at what happens when we trade the XYZ's share CFD. Again, we buy on the 17th of November 1,000 CFDs of XYZ at $10. The value of our position is 10 times 1,000, which equals $10,000. On the same day, we closed the trade at $11. The value of the position became 11 times 1,000, which equals $11,000. Total profit for the trade, also $1,000. In other words, there is no difference between buying the share and its CFD. Contracts for differences exist for currencies like Euro US dollar, British pound US dollar, and US dollar Japanese yen, cryptocurrencies like Bitcoin and Ethereum, indices like US 500, DAX, and JP 225, equities like Microsoft, Apple, and Alibaba, commodities like gold, oil, silver, and sugar. Trading CFDs has several advantages. Investors can trade both long and short positions, thus profiting from both rising and falling markets. Investors can trade using leverage, which can increase profits but also the risk. CFD trading allows for fast execution and low transaction costs. Small contract sizes allow investors to buy portions of the underlying asset. For example, light sweet oil futures have a minimum contract size of 1,000 barrels. Its CFD starts from 25. Trading CFDs requires no physical delivery, thus you limit risk of having to worry about the asset, its storage and insuring it, and more. Trading CFDs also has its disadvantages. CFD owners, for example, have no voting rights since they don't own the asset or stock. CFD positions cannot be transferred to a different CFD provider or broker. Trading with high leverage increases risk. This means that potential profits are magnified, but it is also important to remember that losses are also magnified. Ease of access and low capital requirements can lead to overtrading. Swaps are charged. Comparing Apple share and Apple CFD. Starting with the Apple share. We bought on the 27th of November 10 Apple shares at the New York Stock Exchange at $160. The value of our position equals 10 times 160 equals $1,600. With a minimum commission rate of $15 per transaction, we would be charged $15. Other fees equal $5. Since no leverage is provided, the margin requirement is 100%. So total amount payable is $1,600 plus $15 plus $5, which equals $1,620. Now let's look at what happens when we trade the Apple CFD. We also bought on the 27th of October one lot of the Apple CFD, where one lot equals to 10 shares. So in order to buy 10 shares, we need to buy one lot at $160. The value of our position equals again 10 times 160 equals $1,600, same as its share equivalent. With a commission rate of $0 and no other fees, we would be charged nothing. CFDs also provide leverage. In this example, the margin requirement is 5%. So, in this case, the total amount payable is $1,600 times 5%, which equals $80. The following becomes evident after opening the position. Trading the Apple CFD requires less margin, meaning less money in your account for the same transaction. Transaction costs are less, giving the investor more room to profit from the position. Let's see what happens when we close the position after 5 days on the 3rd of November, 2017. The Apple share price has gone up to $174. The value of our position equals 10 times 174 equals $1,740. With a minimum commission rate of $15 per transaction, we would be charged $15. Other fees equal $5. The total amount received becomes $1,740 minus 15 minus 5, which equals $1,720. This gives a profit of $100, which gives a return on capital of 6%. Now let's look at what happens when we close the Apple CFD position at the same time. The Apple CFD price has also gone up to $174. The value of our position equals now to 10 times 174 equals $1,740. On the CFD, there are no commissions and other hidden fees, but we pay swaps, which is the cost of holding the position overnight. With swaps of $1.6 per day for 5 days equals $8. The total amount received becomes $1,740 minus 8, which equals $1,732. This gives a profit of $132, which gives a return on capital of 165% because leverage gave us the advantage of using only $80 as capital instead of $1,620. The following becomes evident after closing the position. The ability to leverage can magnify the return on capital, but also the risk. Comparing Bitcoin Cash and Bitcoin CFD. Starting with the Bitcoin Cash. We bought on the 1st of October 1 Bitcoin at an exchange at $5,000. The value of our position equals 1 times 5,000 equal $5,000. With a transaction fee of 1%, we would be charged 5,000 times 1%, which equals $50. With a 0.3% deposit and other fees, we would be charged 5,000 times 0.3%, which equals $15. Since no leverage is provided, the margin requirement is 100%. So total payable amount is $5,000 plus 50 plus 15, which equals $5,065. Now let's look at what happens when we trade the Bitcoin CFD. We also bought on the 1st of October 1 Bitcoin CFD at $5,000. The value of our position equals again 1 times 5,000 equal $5,000, same as its cash equivalent. With a transaction fee of 0%, we would be charged nothing. With a 0% deposit and other fees, we would be charged nothing again. CFDs also provide leverage. In this example, the margin requirement is 20%. So, in this case, the total amount payable is $5,000 times 20%, which equals $1,000. The following becomes evident after opening the position. Trading the CFD Bitcoin requires less margin, meaning less money in your account for the same transaction. Transaction costs are less, giving the investor more room to profit from the position. Let's see what happens when we close the position after 5 days on the 6th of October. The Bitcoin cash price has gone up to $5,700. The value of our position equals 1 times 5,700 equals $5,700. With a transaction fee of 1%, we would be charged 5,700 times 1%, which equals $57. With a 0.3% withdrawal and other fees, we would be charged 5,700 times 0.3%, which equals $17. The total amount received becomes 5,700 minus 57 minus 17, which equals $5,626. This gives a profit of $561, which gives a return on capital of 11.09%. Now let's look at what happens when we close the Bitcoin CFD position at the same time. The Bitcoin CFD price has also gone up to $5,700. The value of our position now equals 1 times 5,700 equals $5,700. On the CFD, there are no transaction and withdrawal or other fees, but we pay swaps, which is the cost of holding the position overnight. With swaps of $5.5 per day per unit, the cost is $27.5. The total amount received becomes 5,700 minus 27.5, which equals $5,672. This gives a profit of $672, which gives a return on capital of 67.20%, because leverage gave us the advantage of using only $1,000 as capital instead of $5,065. The following becomes evident after closing the position. The ability to leverage can magnify the return on capital, but also the risk. In our next video, we will talk about cryptocurrencies. Thank you for watching.